What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 27th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about a little kept secret that the vast majority, over 99% of traders, simply don't know about. And on top of that, it's going to help us to understand fundamentally when it's time to usually go long or short Bitcoin, your favorite altcoins, or the broader stock market as a whole. We've got a lot to dive into in today's video. It's going to be a really interesting one, not to mention we've also got a really exciting sponsored interview with Dan Hughes from the team at Radix DLT, one of our favorite layer 1 protocols. So stay tuned for that. You guys won't want to miss it. Consider dropping a like if you enjoy the content, and let's go ahead and kick off the rambling. All right, so I want to go ahead and start by talking about the problem, because at its core, this really is a problem that most traders face. Tell me if this is relatable to you. You followed endless amounts of YouTube videos, read all types of different books, and all different types of resources on how to trade crypto and stocks. But for some reason, as you go throughout trying to understand all this material, if you engrave it into your head, lo and behold, it doesn't hold up. Tends to be that right when you think it's time to go long, when you break past that certain indicator, when the RSI is giving you a certain signal, it's time to buy the dip or sell your position. But at that very moment, when you're starting to see the emotions riding high, you're starting to see the prices hitting those indicators where you should be usually feeling some kind of emotion, you take a trade or a certain position and it goes in the absolute counter direction. For example, I could even say right now, if we take a look back at November, a lot of people saw price rolling back down here on Bitcoin's price during this period of time. Many people thought here or here that we would start to break down, that we would start to collapse lower, and a lot of people started building short positions. And for the months preceding, we likely had a lot of people with each and every price rollover thinking that it was time to go short. However, price started to accelerate higher, and a lot of those shorts found themselves underwater, getting liquidated out of their positions, or even potentially just facing massive losses and closing their positions when they really didn't need to. Sounds familiar? Well, I want to go ahead and talk about why that is. And again, this is a very little kept secret that most people don't think about, and it has to do with a fundamental mental shift in how we think about approaching markets. Well, let's go ahead and think about what's happening right now. We've got this big rally in Bitcoin's price right now, and we're also seeing it in altcoins. We're seeing it in the broader equity markets. People are starting to feel the FOMO, right? Well, what are most people thinking about doing right now? If they're thinking about engaging in some kind of trade, they're thinking about going long. They're not thinking about shorting this rally. Most people are coming back to crypto or still actively trading crypto, and they're thinking, oh my gosh, I got to catch this rally. I missed it. I was short on price. I was doing X, Y, and Z. Many of you might be able to relate to that, as we've been, again, bearish on the long-term trend here, right? We're not trading these intracycle kind of moves very often, right? Unless the setup is very clear. We are sitting in cash, right? So there's a big difference there. Now, why is it that it is not a good time to start thinking about going long, even if prices could continue to squeeze a bit higher here over the next couple of days and weeks? It has everything to do with understanding how institutional traders make money. Now, let's really think about it here. When I say institutional traders, I'm talking about the kind of traders who have millions upon millions of dollars that they need to trade in either direction. And I gotta be honest with you guys, while I'm not trying to give them a lot of credit where it's due, it's a difficult position to be in. Because whereas it's very easy to set up any kind of trade you'd want with, say, a couple $100 or a couple $1,000, there's ample liquidity for that. It is very difficult to enter into a long or short position when you've got millions of dollars. Because if you, for example, want to buy a couple $1 million of Bitcoin or sell a couple $1 million of Bitcoin on the open market or in futures, you could incur a decent degree of slippage. And that starts to eat into your profits. Not to mention, it doesn't allow you to really get a position in without having that effect in the market and leading trend in either direction. All right? So we need to understand here that institutional traders, at the end of the day, the way that they are able to make money is by you following not only your emotions, but the traditional means of technical analysis that people are told work, but in many cases don't. I'll give a great example of this. This can come in the form of deviations many times within price. I want to go ahead and take a look here at the S&P 500. We've got a lot of people right now who, again, are getting very excited that the S&P 500, as well as the Dow Jones and many other indices, and maybe some individual stocks as well, of course, are trending above their 200-day moving average, right? And it seems like every single time we get above that 200-day, the bulls start clapping their hands and saying, it's a new bull market, the bears were wrong, right? And it's time to get long, if you haven't already. And to be honest, a lot of those bears start joining in with the bulls. The crowd of bulls, the excitement, the euphoria starts getting more and more real. But what's happened every single time this has happened, right? Every time we've come up either into the 200-day pocket or even cleared through it, like we did in March of 2020, like we did in February 2020, or like we did here in November and December of 2022. Well, each and every time, this was the period of time to go short. It was the time to either be in cash, not chase the rally, or be effectively short and betting on prices going lower. When everyone is euphoric, you have to be able to trade against the trend, or at least the short-term trend that many people believe is going to formulate into a long-term trend. And I'll be honest with you guys again, I think, again, in order to cause more pain here, we could see this come up a bit, right? This could still go up to, say, 4,200, some kind of higher level above that 200-day that makes you even more eager to chase a breakout above that range. It's exactly what large market makers and traders want you to do. They want you to chase the rally. Because here's the fundamental reason why they need you to do that. In order for them to set in a short position, we're talking about traditional equities here, but this also does play to a degree in the liquidity of futures or derivatives markets when it comes to crypto. In order for a trader, a large trader, to be able to build a large short position, they need a lot of individuals doing two things. They need people who are originally short at the wrong time, who are trying to short all the way through this period of time, say from back here in October to December, to be liquidated from their positions, right? To effectively close their positions, i.e. they have to go out and buy those shares again, propping up prices, providing the ample upward pressure on equity prices, because when you're shorting, you're effectively borrowing shares and selling them immediately. So those people have to go back and buy them. They have to short cover, essentially. And that's what you get, what leads to a short squeeze, right? So that leads to the ample upward pressure for price. And that's going to allow for them to be able to go out and start building short positions, effectively borrowing those shares, right, on the open market and starting to unload them without causing too much downward pressure on price, to be able to really get all of their orders filled in, right? And that allows for, during these euphoric rallies, for the larger institutions, even as it may start ticking up here, to start building those short positions, because they know their time frame is not making a profit tomorrow. It's over the next month, over the next 3 months, and eventually being able to make a trade where they can close their short positions when everyone is starting to short, when everyone is starting to do the opposite, right? That's going to provide them the ample liquidity to exit, otherwise known as exit liquidity, right? So this is a very important dynamic here to understand. The institutional traders need to understand, a smart trader needs to understand how the broader retail audience is going to be trading. Right? I don't want to sit on some like ivory tower and say this is the absolute one key solution to trading, but it is a very important foundation for how you establish your trading, right? Again, same here with going down to the 200 week, right? While we do see the 200 week as a very significant indicator, and a substantial breakdown from that 200 week could signal a continuation of the bear market, we think that that's something that's very important to keep in mind. Same as a really, really far break away from the 200 day, all right? But these small kind of moves above the 200 day or the 200 week are what's known as deviations. They're the periods of time where price make you as a retail trader think, oh my gosh, the end is here. Equities are going to start collapsing. I got to go short, right? I got to go short. I got to bet everything on a price going down, and vice versa. When we get above the 200 day slightly, people start thinking, oh my God, it's a new paradigm. It's the new bull market. I got to go all in, because that's what traditional technical analysis teaches you to think. We've turned previous resistance, right? We've cleared through previous resistance, and now it's time to go up, right? And we don't wait we don't wait for that matter for us to be able to, over say a couple days, a couple weeks, turn that previous resistance into new support, or vice versa, turning that previous support into new resistance, right? That's the problem, is that people are too eager to take the trade, and that's where we mess up. That is where we mess up as individuals. That's where we can start to lose a lot of money as traders and do the exact opposite of what the institutions are doing, to do the exact opposite of what would actually make you money. Now, I want to go ahead and dive a little bit deeper here, talking about something really interesting here, another little interesting perspective. You want to know what a lot of institutional traders are watching right now? They're watching Microsoft and Apple, because these two companies alone are valued at over $4 trillion. That's coming up on roughly, I would say, probably anywhere in between about 5 to 7% of the entire valuation of equity markets at the current valuations that we stand at. $4 trillion. So these two are two of the most valuable equities out there in the public markets. And what's interesting is that if we take a look at an aggregate custom index, this is something we do that I think a lot of traders just don't take the time to do, where you can add Microsoft and Apple. You can start to see here that while the broader NASDAQ might be looking quite optimistic about to cross that 200-day, while the S&P 500 might be above the 200-day moving average. This is the magnet that is going to drag prices in either direction. If Microsoft and Apple can't sustain above the 200-day moving average, you can bet that the S&P 500, that the NASDAQ and the Dow Jones are likely not going to do either. Right? They're likely not going to be able to hold above that 200-day, even if they're trading above it right now. Right? And again, we've seen this already with Microsoft and Apple. We got above there, deviated for about a week, and we came right back down to new lows. Right? And every time we came down here to this 200 week so far, right, this has been the period of time to, in the short term, go long, or at least not to build such high leverage short positions, estimating the price is just going to collapse on a dime. It doesn't work like that. You need a catalyst, right? We usually see that kind of capitulation when the Fed starts to pivot its monetary policy, which we haven't seen yet. So again, this is very important. Again, you can take a look back, see interestingly similar patterns back during the dot-com bubble. We have General Electric and Cisco, two of the largest companies at that time, right? They gave us a lot clearer signs as to where the market was going. They faced resistance at that 200-day, and if you were listening to that, you could start to see, even if the indices were signaling signs of optimism, that these companies, these market leaders that made up a lot of the euphoric gains, that were the plays that people could always rely on when their other plays were laggards in their portfolio, they could no longer rely on these plays. And it's what drove down the bear market's valuation time and time again over nearly 2 years for equities, over 2 years for technology stocks. Brutal period of time. Now, I'm not saying that the NASDAQ or equities are in the exact same position, but I just want you guys to understand that it's not important to chase rallies. What's important is to have the vital signs that price is signaled, the multi-step process that signals to you, Nick, everyone else, it's time to get long or it's time to get short, right? Again, we can't go off of the first step towards a long-term recovery being enough of a sign to go all in. If you think with emotions like that, if you go off of the really kind of simple principles that unfortunately are just outdated at this point, that institutional investors know you're thinking off of because it's TA 101, and even good traders will get chopped up here if you try to follow those principles because of the simple fact that they have the weight, they have the liquidity, they know how to push price in either direction because they've got the mass, they've got the order size. And we as retail traders, we got to be able to lean into that or we're going to lose money time and time again going against it. That's something that, again, as I mentioned before, guys, 99% of traders don't understand or they just simply won't tell you about. And I'm not here to get you guys to trade with, Bybit referral links, with, any kind of derivatives product. I'm not here promoting that. What I care about is you preserving your capital, being ready to really buy the dip, and more importantly, wait until the trend is confirmed. To make trading a breeze, trading should be something that just makes you money almost on autopilot. If you can cut out your emotions and know how the institutions play with you, right? If you can know those two things and maintain those two principles, you make a lot more than the vast majority of traders out there who lose money in the end. especially day traders and the likes of that. You want to stay away from that. To just kind of wrap up our conversation here, right? One thing that I really want to dive into before we dive into the interview with Dan is taking a look at our Crypto Quant dashboard. Now, if you guys have not been following this yet, it's a free dashboard. You guys can sign up for an account. Don't have to pay anything. If you want to pay for one of the paid plans and stuff, that's totally fine. But you guys can get free access to this. This is our Crypto Quant dashboard that has some of our really interesting models that we track. One of our unique ones, the supply and profit percentage, which takes a look at on-chain positions that are in profit from where that Bitcoin was last moved. Again, we can see here, we have gotten nowhere near the kind of typical traditional crypto bear market capitulation that we've seen, right? So again, we've had many bump ups like this before where the indicator rallies up for a little while, but then it fades right back down. So again, I wouldn't be chasing this rally so much. Not to mention, taking a look here at the Plum multiple, right? See, again, we have not gotten down to that kind of capitulative territory. And again, considering the macro environment here that does have a weight on crypto, we haven't even seen the typical correction we've had in a normal crypto bear market, right? Where the Fed was always coming to the rescue. We got to understand that the dynamics, the liquidity shift has changed, right? There's been a major change in the way that liquidity is moving right now. And because of that, we got to expect likely at a minimum what we've seen in the past, if not worse, right? This has to do on a much more fundamentals basis of understanding where that liquidity is coming from. Where is it going to come from? Fed can't save us. Cost of goods and services are still relatively high and suspended. The Fed's tightening interest rates. They're tightening their balance sheet. They're reducing liquidity. Where are the buyers going to come from? Again, I come back here to this topic of Bitcoin. Gotta be honest with you guys, we could come up here to 25, 26K over the next couple of days, right? But again, this is exactly how the exchanges get you. They know where the shorts are forced out of their positions. They know when longs will be forced out of the positions. Ideally, they're gonna drive prices higher, liquidate as many people as possible, start building positions in the opposite direction through funds and investment vehicles, and they're gonna make money both ways. And all the while, you lose everything, you pay trading fees, any money in is money in for them. That's how the game works if you trade like an emotional trader. But if you can do the opposite of what everyone is saying, in the majority of cases when it comes to shorter term trading, you can start to make some decent money. So anyways, guys, that's it for today's video. Let's go ahead and dive into the interview with Dan Hughes from Radix on a more positive note to talk about some of the exciting developments that they've got going on at Radix. Alrighty, everyone. So in today's sponsored interview, I'm sitting down with Dan Hughes, who is the founder of Radix DLT. He's been leading the development forward on the lead consensus mechanism Cerberus, which allows for Radix to not only offer a whole range of interesting UX improvements, but on top of that as well, leads to higher degrees of scalability for the network. Dan, I have waited a long time to get to speak to you, man. I really appreciate you making the time. You were heads down working alongside peers and many others of the team. So thank you so much for making the time. I really appreciate it.
No worries. No worries.
Awesome, man. So I want to go ahead and dive into a little bit more of the technical conversation, because if people have been watching the channel frequently, they've heard me mention Radix over the past couple of years. We've been following the project for a long time. And I know that your specialty is really around the consensus means and really a lot of the core technology that Radix has been based on for a long period of time, especially even now as it's kind of pivoting and focusing a lot more towards DeFi. So I wanted to talk about, before we even dive into Cerberus, talk about the important concepts of composability and scalability, because I think we hear about the latter a lot, hearing about like being able to scale to a certain number of transactions. That's all fine and good. Some other networks out there can scale to quite a high degree. But what you guys have built is not only means to scale heavily, but also maintain a faction or a factor, in this case known as composability. So could you talk a little bit about the difference between those two?
Sure. It's not so much a difference. It's more of being able to provide that feature, right? So composability is important because you're able to, create a sequence of actions that result in some desired outcome, right? So you can say, okay, I've got this token A and I want to go through this swap pool to get token B. Then I want to go and take advantage of some arbitrage on some DEX platform somewhere or another pool or, flash loan or something. do something there, get some tokens C, and then send those tokens C to somebody and some back to myself, right? So you're kind of composing these different DeFi products or different types of instruments and stuff so that you can have a much more kind of colorful experience, right? Instead of having to do these things one by one manually, you can compose them together into a transaction.
Single transaction, yeah.
Into a single transaction, yeah. And then you hit send, and it goes off, and the network, does what it is that you want it to do. And that's becoming ever more important with DeFi, and then eventually you will start to see this composability requirement perhaps leak into other types of kind of Web3 applications, right? Like NFTs or social platforms, or whatever else pops up in the future. It'll be extremely integrated, and so composability will be really, really important. And what really breaks when you have scalability, it isn't so much the composability, because you can still put things together that way. What breaks is the atomicity, right? So when you compose a complex transaction on Ethereum right now, you don't have to worry too much about atomicity, because it's not sharded, or you don't have any side chains or subnets, all these different names for things, right? Layer ones, layer twos and stuff. Everything is kind of monolithic within the Ethereum chain. But then when you start to scale that out with different scalability methods, say you have two side chains, what then breaks is that these composed pieces of this transaction get executed
on separate parts. Exactly.
So the first thing happens over here, and if that's successful, the second thing goes and happens somewhere else. Might be in a roll-up, or on a subnet, or a side chain, or whatever the topology of that network configuration looks like. And ideally, what you want is these things to be atomic, right? I don't want token C if it fails. Yeah, I don't want to be left with a bag of token B that were meant to be arbitrage, but because the arbitrage opportunity went away, it couldn't execute, and so now I'm left with tokens B. What I actually want is just to keep my tokens A, right? And that atomic composability is the real important factor, because you want all or nothing. Yeah, either everything happens or nothing happens.
Exactly. I was just going to build on that point, Dan. Like, I remember from the RadFi event that Pierce was bringing up a metric I hadn't even heard of before, which was that, roughly speaking, about like 2/3 of all transactions include more than one, I guess, transaction type or a specific action. So it's not just a swap on Uniswap or a send transaction. People are doing exactly as you said, like arbitrages, all these mixture types of transactions in one singular transaction. And when you start offering, like, there's a lot of scaling solutions. There's ETH2, or what is basically now kind of going to be the move to proof of stake, and then eventually sharding. And then you've got layer twos like Arbitrum. The problem is that you really, again, are starting to have questions and doubts around that composability on those scaling solutions. While you can be able to bring network fees down and maybe offer more transaction output, you don't have that same kind of freedom to have a more efficient marketplace. And I think this is incredibly important for DeFi as an application.
Yeah, for sure. It's important for DeFi from a user perspective, from a developer perspective, from a technology perspective, right?
Yeah.
If you're not able to take these different DeFi instruments and put them together in interesting ways, then you're kind of pigeonholing what
the
DeFi
use
can
cases.
do.
Yeah,
it just becomes very limited, right? And it doesn't need to be that way, because it is possible to compose these different things together in these interesting ways, and it's just a case of, okay, like, even in the worst case, there are ways around this issue of having no atomicity, right? But the burden of being able to deal with that then falls down to the developer, right? So in the case of our example, if the arbitrage had gone, then the developer then has to build logic into his application so that you can undo the swap to tokens B, right? But because you're doing that in a serial way, you still may end up with less tokens A than you started with because slippage in the pool, right? Or the price has moved since. So it's not ideal, but you can undo it, but it just becomes a spaghetti of edge cases.
And as if we need any more technical debt or like edge cases that developers have to, care about. I talked with Pierce and stuff again. I had a crypto wallet before, and it honestly, like, it, Dan, like the issues that developers have to already worry about, whether it's smart contract development or even just building apps in crypto is already frustrating enough. And having to worry about whether or not the base protocol can, basically avoid these edge cases or issues that can leave people losing lots of money, getting hacked, or having any kind of major security vulnerabilities. It's a huge frustration point. But I wanted to talk now, like, on kind of the solution. And we understand this problem, I guess, now, composability, or more specifically, atomic composability. But I want to talk a little bit about Cassandra and how this leads into Cerberus. So my understanding is that Cerberus overall is this consensus means that you guys have been working on for a long period of time. And on top of that, Cassandra is kind of what I would see is kind of like a test environment for what is going to be really potential on top of the Radix network. So could you talk a little bit about some of the projects? I've watched a lot of your live streams over the past year or so, and you've been really candid in showcasing the work you're building. So I'd love to hear, maybe kind of share with people who maybe haven't seen that. What are some of the things you guys have been able to do with the scalability of Cerberus as a consensus means? Maybe even how does it work as well on a surface level?
So Cassandra initially started off as a purely research network for internal use, really, right? Yeah. To answer some concerns that I had about, okay, what does a Xi'an actually look like, right? So you can think of Cerberus as, I've used this analogy a few times a couple of weeks ago at a conference. It went down really well. So you can think of Cerberus as the rocket engine, right? But the Cerberus paper and the Cerberus protocol doesn't give you any information about how do you build the rocket, right? So what does the fuel system look like? How do you do the control surfaces? What does the body look like? The payload delivery system, how does it land? If you're doing a SpaceX style rocket, right? Reusable and stuff. It doesn't give you any of that instructions to build that, right? So I wanted to be sure that we could build the rocket that houses this Cerberus engine. And that's as an analogy, that's what Cassandra is, right? Cassandra is the rocket and the engine in one package. And the Cassandra demonstrations are test flights, essentially, of that rocket to see what it can do, right? How high can it go? How fast can it go? How heavy a payload can it carry? I'm going to leave the rocket analogy now because I think it gets the point. So that's initially how Cassandra started. But then after a few months, it got to the point where it was like, okay, I've kind of quashed some of these concerns, some of the main concerns that I had about, what bullets would we have to catch further down the road? What speed humps are we going to hit? Is there going to be anything significant that can derail us from our goal of Xi'an? And then it just kind of became okay, so what can we actually do with this stuff, right? Are there any improvements that could be made to the Cerberus consensus mechanism? And what does that look like? Are there any interesting features that we haven't thought about that manifest out of this technology? We could do some tests with it, like we could test the scalability. We could see if it is linear scalability. The more resources you add, the faster it can go. And so it really evolved from an R&D network into what's more of a kind of showcase network now, right? And some of the things that are showcased on there, we have like a wallet, obviously, for some what are called flex tokens. A very nice name because it's kind of a flex, I guess. A Twitter application, which people say, Twitter's been done, yeah, but there's no decentralized Twitter out there where there's over 100 terabytes of tweets stored on
exactly
Ledger. And a kind of YouTube, Netflix kind of demo where you can upload videos and they get streamed off the Ledger, and you can do live broadcasts and all these different kind of crazy applications. And everything that I think of trying to do with it ends up being possible, which is a bit insane, really, because
I was going to say on that point, Dan, like we even had someone in the Dash report group who had uploaded, I think like it was other than DJing or some kind of like music compilation on top of Cassandra. He asked you to upload it and it was a massive file size, but you guys were
Oh
able
yeah,
to.
you're talking. Oh yeah,
Yeah,
the kind of deep house mix. Yeah,
exactly. Yeah.
it was 4K video and audio. Yeah, and it was about 20 gigabytes, if not more. It was absolutely huge.
Wow.
And then yeah, I tweeted the link out for that. And I think quite a lot of people hit that link. I don't remember the numbers now, but it was quite a lot. I posted it on Reddit as well, and it got quite a bit of traction on Reddit back then. And it was serving this stuff, no problem at all, which was quite crazy.
Yeah, I'll share some videos up on the screen, guys, so you guys can kind of see some of the things that Dan has built and just again what people have collaborated on top of like Cassandra as a network. But I think it's incredible to see what kind of applications, and these are even more, as you mentioned, Dan, like these are kind of like Web3 implementations of Web2 apps that are already out there now. And now, like what I think about is what is possible on top of Radix as a network now with this kind of scalability. I mean, obviously, I know Radix has a premier focus on DeFi, and that also kind of bridges in NFTs as well, because I think that is where a lot of really the untapped value still remains. There's GameFi and other areas that Radix accommodates for, but this really can go anywhere. I mean, you can build all kinds of different things with script.
Exactly. I mean, it's like the hosting videos on Ledger, right? I mean, it's probably not a sensible thing to do unless you've got the business model nailed down for incentives and how you would monetize it and stuff. But the real point of these demonstrations on Cassandra is it's not about whether it's a good idea. It's about look what this can do, right? Look, this can operate at scales, really high scale in different domains, right? Not just the throughput of transactions, but data management and all this kind of stuff. Huge amounts of data are being managed seamlessly alongside, transactions going through the network and tweets being imported from Twitter. And those tweets have got images associated with them and videos attached that are pulled from Twitter and get stuffed on Ledger as well. And all this is going on at the same time. And there's websites hosted on there. I mean, it's because underneath everything, even though there is this focus on DeFi, because the consensus model, the Cassandra consensus, which builds on top of Cerberus, it's kind of like a supercharged Cerberus, I guess you could say. It's so kind of general purpose that if you have an execution environment that can deal with the information that you're sending it, then the consensus mechanism doesn't really care what you're giving it. All the consensus mechanism sees is, okay, I've got these blobs of data that I need to get agreement upon across n number of validator sets and across these different shard ranges. And then some execution happens and that spits out a Boolean yes or no answer. And then the consensus deals with, kind of committing that information, committing the state transitions and storing it on these various machines. And because it's so abstracted, because it's so general purpose, then there shouldn't be any real application that we shouldn't be able to build, demonstrate.
I think it's incredible, Dan. Like again, if you guys want to, what I'm going to go ahead and do is I'll leave some links down below so you guys can get access to Cassandra. I think, as you mentioned, Dan, we were chatting about before, you guys took it live about a month ago, maybe a little over a month ago, and people can now actually go and see it, kind of maybe get a hands-on experience looking at what's been built and how it operates. But I'm curious, like, what's kind of the best way for people to get a feel for the platform? What are some things that you think they should know about, or maybe some resources they could dive into? Is it reading into Cerberus about it as it is a consensus mechanism? But maybe what's the most palatable way for people to really get?
I think if you're extremely technical, then we as a project put out a lot of technical information, right? So we have various papers and technical documentation, online help and wikis and all this kind of stuff. We have a Discord server where we have some technical groups in there. If you're maybe not quite so technical, then you can go and play with the Cassandra demos, right? I can give you a link and you can put it in the description.
Yeah, for sure.
And there's a bunch of stuff on there that you can go and play with a Twitter demo, and you can go and search for your favorite Twitter influencers, or some hashtags and things, and it will bring up real tweets that these people have made in the past as it's pulling them from Twitter. Upload some videos and things. So if you're kind of more kind of hands-on and you want to just try something out, then that's a good way. There's also a Cassandra Telegram group, which I can give you a link for as well. Awesome. Where members of the community join, and they help me to run tests or demos or spin up new instances, or if I've been down the rabbit hole for a few weeks squashing some bugs, will pop up in there, and they'll spin up a validator and help me to just verify and run some tests and things like that. So there's a bunch of different ways that you can get involved. If you're a developer and you're interested in what Radix is doing from the DeFi point of view, then you can go and download the Scripto Babylon AlphaNet that is out at the moment, and there's a beta net landing in a few days as well, where you can build applications using Scripto, which is our DeFi language, if you like. It makes it easy for developers to build this kind of stuff, and you can try it out. You can build some Radix version of Uniswap or swap pools, flash loans, all this kind of stuff. And you can deploy it to the test networks, and you can play around with it. So there's so much you can do if you want to get involved, from a really high level all the way down to a really low level.
Yeah, I think that's the cool thing, guys, is like, as many of you probably saw from the RAD5 event, if you tuned in like I did, it's amazing to think about what kind of applications, I mean, not only with this kind of ability to maintain atomic composability, what that's going to allow for, but on top of that, to be able to see what kind of applications can be built in such a short and compact means through Scripto as a language. I mean, it's absolutely insane. I remember, like, Dan, like one of my aha moments outside of watching like your live streams, it was, I think, when Russell did that demonstration of Radiswap, and being able to see and understand like the infrastructure behind Uniswap coming down into a framework built in Scripto, and seeing just how much developer time that saves, how simplistic the language is for even a non-engineer like myself to start to understand. I mean, that is, increased developer efficiency, increased user experience, high scalability. I mean, this is exactly what you guys need to succeed long-term. So I'm rooting for you guys, man. I'm so happy to have known you guys for so long, to finally get you here on the channel, man, to chat about it and show some of
long overdue.
Yeah, man. And get to show people as well some of the things that you've been building on. I think this is, especially out of anyone, it's very rewarding for you, because you've been working on this for a very, very long time, especially in crypto years, like
10 years in real years, which is about 7,000 years in crypto years.
Exactly. Well, Dan, I know we definitely have to have you back on the channel, guys. Again, if you want to get involved, like, check out the links down below. If you're more kind of on the surface and you're thinking about just kind of getting involved with Radix as a staker, or even potentially messing around with Scripto, I've been getting the edge, like, to learn a little bit of Scripto myself as well since RadFi. So if you guys are interested, I'll leave kind of those core links down below in the description. But Dan, thank you, man, for making the time. It was such a good conversation.
My pleasure.